Debt to income and mortgage insurance, two numbers that can make or break your FHA loan approval. Yet, most first-time homebuyers misunderstand them. And that mistake could cost you thousands, or in some cases, it could cause your loan to be denied entirely. So how do you get it right? In this video, I'm going to break down both debt to income ratio and mortgage insurance so that you fully understand them. And better yet, I'm going to go over some numbers so that you can do the calculations on your own. So for those of you not familiar, what is an FHA loan? An FHA loan is a loan that's guaranteed by the Federal Housing Administration. In layman terms, it's basically a loan that's backed by the federal government. But here's where a lot of people misunderstand that as well. The loan isn't done by the federal government. They just back that loan in case it defaults or something happens with that loan. The government is a backstop for the lender in case you end up defaulting on that loan. And with that said, the government isn't the one doing those loans. You're going to have to go out to a broker who's licensed to do FHA loans, which we'll actually talk about later in this video. So the first thing I want to talk about in today's video is debt to income ratio. Debt to income ratio is your monthly debts divided by your monthly income. And if you're wondering this, going, why is this important? Your debt to income ratio is essentially how your lender determines how much home you can actually buy. Now, there are some other factors that influence that number as well, but essentially your debt to income ratio tells the lender the max housing payment that you can actually afford based off the debts that show up on your credit report and your gross monthly income. Now, something to notice with what I just said, I said your gross monthly income. This is your income before any taxes come out, before you pay into your 401k, before you pay into your deferred comp, before money's taken out of your check for spousal support or child support, or in some cases, judgments that you might have. And the reason the lender uses your gross monthly income is because people have different exemptions. They write off different things out of their income. So in order to keep things simple to calculate, the lender uses the gross amount. And that's why it's really, really important when you're applying for a loan that you've done somewhat of a budget so that you know exactly how much home you can afford. Because what's going to happen is when the lender calculates your debt to income ratio, they're going to tell you the max amount that you can qualify for. But that doesn't mean that's how much you should go out and spend, because it's all based off what you're comfortable with based on your take home pay. So this is your net income, if you will, after your taxes have come out, after you've paid into your 401k, your net income. How much of that do you want to use towards your mortgage payment? And the easiest way to figure this out is basically go back through the last 90 days of your checking account and see what you've spent money on, and start doing a budget based off groceries, based off date nights, based off childcare, all of these different things to figure out how much money you have left over at the end of the month that you're comfortable spending on a mortgage payment. Because that's not what the lender's going to do. They're going to use your debt to income ratio, which is what we're talking about right now. So the first thing we're going to do in order to calculate your debt to income ratio is figure out your gross monthly income. Now, in the case that you've had consistent income over the last couple of years, the easiest thing to do is just take your W-2s, and I'm going to say your last 2 years of W-2s, and you're going to add them together. So let's just say, for purposes of our video here, that this last year you made $110,000 in 2024, and then the year before that you made $90,000. So combined over the last 2 years, you've made $200,000. Now, I realize in some cases it's not that simple, especially when you're self-employed. Now, self-employed is going to be a little bit different because of the calculations, and I'll talk about that more in just a minute. But let's just say you make $200,000 over the last 2 years. Well, we're going to divide that by 24 because there's 24 months in 2 years, which is going to break down to $8,333 per month. So that's essentially the gross monthly income that we're going to be working with in today's video. Now, the next piece of this puzzle is figuring out your monthly debt. Now, this again is just the debts that show up on your credit report. This is things like car payments, credit cards, student loans, any sort of installment debt where maybe you went out and bought furniture, or in some cases maybe you did a buy now, pay later. That sort of thing is going to be factored in to your monthly debt. What we're not considering are things like what you're spending money on for gas or groceries or date nights or childcare or anything else like that. So what we're going to do is add all of those monthly debts up, and that's going to help us figure out what your debt is so that we can divide it into your income. But before we do that, we need to understand how debt to income ratio actually works. There's a front end ratio and there's a back end ratio. The front end ratio of your debt to income is the housing expenses, the proposed housing expenses of the house that you're looking to buy. It's going to include the principal and interest. It's going to include the property taxes, the homeowner's insurance, as well as any homeowners association dues if there's anything like that on the property. And in the case of FHA, they allow you to go as high as a 47% on your front end ratio, which basically means that you can spend up to 47% of your gross monthly income towards your housing expenses. Now, I know what you're thinking. That's absolutely crazy to spend 50% of what I make before I bring home taxes on my housing expenses. And it is. That is a very, very high number, and it's not something I would recommend. But in some cases, people have income that doesn't actually report on their tax returns. Maybe they have a side gig and they're getting paid cash and they're not counting that money as part of the documentation. So in some cases, people have more money or are making more money than they're actually reporting. And maybe in those cases, you could justify going up to these ratios. But if you're someone doing these calculations and this is really all the money you make, I probably wouldn't recommend going up to a 47% on your front end ratio. But with that said, there's also a back end ratio. The back end ratio is those same housing expenses on the front plus any monthly debts that you have, those things that came off the credit report that we talked about a minute ago. And that number cannot exceed 57% on the back end, which means you can have housing expenses at 47%, and then you can have your monthly debts, which essentially is another 10%, allowing you to go to a total of 57% on your debt to income ratio. So you're probably going, okay, Jeb, what does this actually mean? So in the case that you're buying a $400,000 home and you're using an FHA loan, your minimum down payment with that loan is 3.5%, which in the case of $400,000 is going to be a $14,000 down payment. And once you factor in the upfront mortgage insurance premium, which we're going to talk about here in just a minute, you're actually going to be financing $392,755. And if you were to get that loan today at a 6.5% interest rate, your principal and interest payment would be $2,482 per month. But on top of that, you're going to have property taxes. Now, the nationwide average is 1.1%. But depending on where you're located in the nation, areas like Texas, New York, Florida, some of these areas, the property taxes are much higher than the nationwide average. So just make sure you know the number where you're located so that you can calculate this correctly. But I'm going to use the nationwide average at 1.1%, which means your property taxes are going to be $367 per month. In addition to that, you're going to have homeowners insurance. Again, this is going to vary by region, but a reasonable amount to assume is somewhere around $100 per month. And then the last thing we're going to factor in is the monthly mortgage insurance. Again, this is something we're going to be discussing in just a minute, but that is 0.55% of that base loan amount that we discussed earlier, which means you're going to have $180 per month in mortgage insurance. So all in, that mortgage payment would be $3,129 per month. So in order to figure out our front end ratio, we take that $3,129 and we divide it by the gross monthly income of $8,333, which gives us 0.38 or 38%. So in the case of FHA, we've met the front end ratio because we're below that 47% that we mentioned earlier. So we've essentially checked that box, but the question is, do we qualify on the back end ratio? Let's say in this example, we have an $800 car payment, we pay $500 towards credit cards, and we have $200 in student loans. All of that shows up on my credit report, which in this case is $1,500 of monthly debt. So we're going to take that $1,500, we're going to add it to that $3,129 housing payment, and we're going to divide that by our gross monthly income, $8,333, which is going to give us 0.56 or 56%, which in this example is under that 57 max that we mentioned earlier. So assuming you meet all the other qualifying guidelines of FHA, then in theory, you should meet these max debt to income ratio requirements. But this is something really, really important to note. Not all lenders have these same ratio requirements, and that's because some lenders have overlays on their programs. FHA allows you to go down to a 500 credit score if you put 10% down. And they also allow you to go down to a 580 credit score, putting just 3.5% down. But some lenders out there don't allow those same qualifications. They have overlays, which essentially is another layer on top of the base requirements that says, hey, yes, FHA requires this, but we require something higher. We require a 640 if you want to put 3.5% down. Or in some cases, we don't go higher than a 50% debt to income ratio across the board. So understand when you're getting turned down by one lender, you should ask them why. Why don't I qualify? And the reason I say this is because oftentimes our team here is helping people that got turned down in other places because they were told they couldn't qualify when in all reality, they could qualify, but they just weren't using the right guidelines. So when you're going through the process and you're using FHA, just make sure you're using a lender that understands FHA, that does a lot of them. In fact, our team here helps a lot of people on YouTube with FHA loans. So if you want to get in touch with us, use that link in the description of this video. Now, the next thing I want to talk about, which is often misunderstood with FHA, is mortgage insurance. Not only are we going to talk about what mortgage insurance is, we're going to talk about why it's required. Understand that mortgage insurance isn't there to protect you. It is there to protect the lender in case you end up defaulting on that loan. It's there because FHA allows lower credit scores. They allow you to put less than 20% down. So in theory, you're a higher risk to that lender than someone that's putting 20% down or 50% down, or someone who has 750 or 800 credit scores. Now, in the case of this, you might have higher credit scores, but the way FHA looks at it is that you're still a higher risk. So not only are you going to have monthly mortgage insurance, you're also going to have something called upfront mortgage insurance. Now, before I discuss the differences in the two and show you how to calculate them, I want to start by saying mortgage insurance is not a bad thing. There's a lot of people out there on the internet that says you should not get an FHA loan, or any loan for that matter, because it has mortgage insurance. And trust me, I can understand why they say that, but at the same time, it usually comes from somebody that doesn't understand finance and doesn't understand how long it actually takes to save up enough money to avoid mortgage insurance. The way to avoid mortgage insurance is having at least 20% down and essentially using a conventional loan. Now, for most people, that's not an option, and I completely understand that. So the way I look at mortgage insurance is it's the cost of doing business. You can either choose to have mortgage insurance now and buy a house and reap the rewards of home ownership, or you can wait until you have at least 20% down and buy a house then. Now, for most people, that's going to take years, 4, 5, 10 years to save enough money to be able to avoid that mortgage insurance. And my question for all of those people is, what happens to home prices during that period of time? Well, if it's anything like the last couple of years, that means home prices are going to go up during that period of time. In fact, home prices have appreciated nationwide 4.6% over the last 65 years. So in the case that you're out of the game for 5 years or 10 years waiting to save that money, you're missing out on somewhere between 20 to 40% equity gain in just a normal appreciating market. But with that said, there is one downside to mortgage insurance with FHA, in that it's on the loan for the life of the loan. So as long as you have an FHA loan, you're going to have mortgage insurance when you put that minimal down payment of 3.5%, unless you refinance out of it into another loan. Now, if you put at least 10% down, then that mortgage insurance will fall off after year 11. But until year 11, you're going to have mortgage insurance on that loan, even if you have 20% equity in that property. So going back to what I said earlier, there are two types of mortgage insurance with FHA. There's upfront mortgage insurance, which is required on every single FHA loan, regardless of credit score, regardless of down payment. It's 1.75% of your loan amount after you put your 3.5% down. So in the case that we said earlier that you're financing a $400,000 home, that's a $14,000 down payment. That means your base loan amount's $386,000. Well, you have to add that 1.75% back on to that base loan amount, unless you plan on paying that amount out of pocket. Now, most people choose to finance it because FHA allows it. But if you don't want to finance it, you can actually choose to pay it through your closing costs and not have it financed into your loan. But what I'll say is, in doing this 20 years, I don't know anybody that's ever paid it out of pocket. They always finance it. So what you do is you take that $386,000 and you multiply it by 1.75%, which in this case is $6,755. Now we add that back to our base loan amount of $386,000, which gives us a new base loan amount of $392,755. And this is the loan amount that everything is going to be based off of. Your mortgage payment, your monthly mortgage insurance, all of those fees are going to be calculated off that new base loan amount, which is going to take me into the monthly mortgage insurance that you're going to have with FHA. Currently, that amount is 0.55% when you're putting just 3.5% down. And the reason I'm using this as example is because most people that use an FHA loan just put 3.5% down. Now, something to understand, that fee, that 0.55%, has changed over time. It was 0.85% just a couple of years ago. It's actually been lowered. Now, there's a chance at some point in the future it could be lowered again, But at the moment, we're using 0.55%. So we take that 392,755, we multiply it by 0.55%. It's going to give us an amount of $2,160. So this is the annualized amount. This is the amount for the entire year. In order to get the monthly amount, we divide it by 12, which in this case is $180 per month. Now, again, something to understand. Regardless of your credit score, you're going to have monthly mortgage insurance. There's no way around it with FHA. But as we discussed earlier, once you get enough equity in that property, assuming you can still qualify, you can refinance out of that loan into another loan. But here's what I'll tell you. I have clients that bought using an FHA loan back in 2020, 2021, early parts of 2022, and they were able to get FHA loans in the low 3%, high 2% range. And at that time, mortgage insurance was 0.85%. So all in, their total rate is somewhere between 3.5 and 4% on these loans once you factor all of that in. And where we sit today with FHA, interest rates somewhere between 6.5% and 7%, those people are really, really well off. So for all of the people out there saying you shouldn't have bought using an FHA loan, I look back to those people and go, well, those people are sitting in 30, 40, 50% equity in some cases. They have a combined interest rate with mortgage insurance under 4%, whereas people today are buying with higher interest rates. Who was the smart one in this case? So when you're going through the process, you're talking to a lender, you're getting your options on paper. Maybe you're thinking, I don't want an FHA loan. Maybe in cases you're thinking FHA is the only loan. Just make sure your lender is giving you side-by-side comparisons of all the loans that you qualify for so that you can see everything on paper. You can see, what your interest rates are. Interest rates are typically lower with FHA. So yes, you have mortgage insurance. You usually have a lower combined rate because the interest rate's lower than it is on conventional loans. So just get all of that stuff on paper, compare the monthly payments, compare the money that you need to bring in to close that loan so that you can make the right decision. Now, as I mentioned earlier, if you want to work with a professional team, we help a lot of people here on YouTube, and you can reach us using that link below. Now, because I was just talking about mortgage insurance and debt to income ratio in this video, I'm sure some of you are going to have questions. If you do, make sure you drop them in the comments and I'll be sure to get back to you with the answers. But with that said, what are your thoughts on FHA? Do me a favor and let me know below. While FHA loans can be a great option, just understand that debt to income ratio and mortgage insurance matter. So before you start applying for loans, just make sure you know your budget, know your numbers, and make sure you have a strategy. And lastly, if you found any value in today's video, do me a favor and hit that thumbs up and make sure you subscribe to the channel to stay updated on everything mortgage related.